There's been a growing concern among shareholders of SCHD about how this ETF has been performing over the past couple of months. Unlike a lot of dividend-paying investments, including other dividend growth ETFs, SCHD hasn't fully recovered from the tariff drama that we experienced in early April. And it's actually been lagging behind all of their major competitors, which I'll go into more detail here in a bit. Additionally, this all started right around SCHD's annual reconstitution, which is when this fund makes updates to its holdings. This has also fueled speculation that this ETF might have made some seriously bad choices this year when they were adjusting their positions. In this video, we'll examine how this ETF is doing, try to figure out the reason for its underperformance and what we can expect going forward. Maybe even if we should consider replacing SCHD with a different alternative dividend growth fund. First, we need to address something before discussing the performance of this ETF. When I say it's been underperforming, I'm not comparing its performance to the S&P 500, which is a very common mistake that I see people make. It's a pet peeve among all dividend and income investors when people do this, because dividend investors are pursuing a completely different investing strategy than those who hold index funds. You cannot compare SCHD to the S&P because one is focused on paying growing income, whereas the other is focused on rising valuations. Companies that pay dividends are choosing to distribute some of their earnings to shareholders instead of retaining that money to grow their valuations. I like to say dividend-paying stocks trust me to spend that money the way I would like to spend that dividend money, as opposed to letting them keep that money and doing whatever they want. That could include offering bad products or services or giving themselves bigger bonuses. If you invest in SCHD, you do it for the dividend payments. If you hold SPY or another S&P 500 index fund, you hold it because you hope valuations will rise in the future. Many dividend and high-yielding stocks do beat the market, but many don't. But you cannot compare SCHD to a market index fund because both are fundamentally different. So whenever you hear someone ask, why would you invest in SCHD when you could hold SPY, you know to ignore their opinion. But we need to pull up this fund's share price performance on a chart to get a good glimpse of this underperformance we're talking about. Over the past 6 months, we can see that the Schwab ETF is still down 7.82%. If we compare it to its top competitors, we can see that it's been pretty disappointing. For this comparison, we'll include VIG, which is the Vanguard Dividend Appreciation ETF, DGRO, the iShares Core Dividend Growth ETF, and SDY, the Spider S&P 500 Dividend Growth ETF. These are among SCHD's top competitors in terms of assets under management, and they have similar investing strategies. We can clearly see that SCHD, represented by the dark blue line, is falling behind all of these alternatives that exist. Although none of these funds are up in share price in the last 6 months, SCHD is still the furthest behind. This is leading some people to consider dumping this ETF for one of these other dividend growth funds. If we look at the year-to-date performance of all these funds together, it becomes even more clear that the Schwab fund is suffering from lagging share price performance. Because every other fund has performed the same when talking about share price performance, but SCHD just hasn't been able to keep up with these other options that exist. So what's the reason for this ETF struggling to recover up to where its alternatives are? Let's look again at what happened during this fund's reconstitution. This took place at the very end of March, just a couple of days before the tariff drama and Trump's Liberation Day. If we go back to the adjustments that were made, we'll see that the biggest sector to be eliminated from SCHD this year was financials. This would include banks and other financial institutions. Since April, this sector has done really well with recovering, so this is likely one of the biggest drivers for its underachievement. What I think was a really great move on this fund's part was removing a lot of consumer discretionary stocks. This sector is unlikely to recover anytime soon with all the tariff drama still going on. Looking at the consumer discretionary index, we can see it suffered a lot in the last 6 months. When we now look at the new additions to SCHD, we can now likely see the number one reason why its share price has been lagging behind. Schwab added even more energy stocks to this ETF than they had before. This means that right now, SCHD holds more energy stocks than any other sector that exists. 21% of its holdings are now companies involved with the energy sector, significantly more than all of their competitors. To put that into perspective, energy stocks only make up 2.89% of VIG. DGRO is roughly 4% in energy, and the other two ETFs don't even come close to having as much energy stocks as is in SCHD. Looking at the energy index, we can see that it's a sector that's been lagging behind over the past couple of months. Although Trump previously stated that the energy sector would largely be excluded from his tariffs, there's just been a lot of pessimism driving these companies downward. There's other factors that come into play when it comes to energy, which is being indirectly impacted. Because of these tariffs, fewer goods are being sent to America, which is driving down the demand for oil. If there is a recession like people are speculating, that'll also drive down the demand for energy products. What's unusual is that some countries are actually increasing oil production, even though demand is expected to fall. So with a large influx of oil and already a slowing demand for energy, it's been causing this entire sector to underperform. This is undoubtedly the number one factor in SCHD falling behind since it makes up so much of this ETF. Other than energy, nothing really stands out when it comes to these other sectors. Ultimately, this fund didn't do anything that it wasn't supposed to during its last reconstitution. It still followed the exact same guidelines when it comes to picking investments and kicking investments out that it's been using since 2011. According to this fund's prospectus, the index it tracks is called the Dow Jones US Dividend 100 Index. In order for a company to be included in this index, there's a few requirements that it has to have. A company must have sustained at least 10 consecutive years of dividend payments and have a minimum float-adjusted market capitalization of 500 million USD. So smaller, more speculative companies wouldn't be considered for addition here. Plus, each company is required to meet their minimum liquidity criteria. The components are then selected by evaluating the highest dividend-yielding stocks based upon 4 fundamental base characteristics. That would consist of cash flow to total debt, return on equity, dividend yield, and 5-year dividend growth rate. Despite including the highest yielding stocks, the index excludes real estate investment trusts, master limited partnerships, preferred stocks, and convertibles for tax-saving purposes. This strategy used by SCHD has resulted in the best dividend growth out of all of their competitors. Remember, it's not just about share price, but also how fast they can grow their distributions. This is a breakdown of the 5-year dividend growth rate for all of the ETFs that have been mentioned so far. SCHD continues to lead the pack, although just slightly ahead of VIG. Just recently, the Vanguard fund has been catching up, as it's usually further behind than this. So we'll have to see if they actually can overtake SCHD or not. So to summarize what we looked at, SCHD isn't broken and they didn't make any incorrect picks. They're still abiding by what they've always done since launching this ETF 14 years ago. Energy is the main culprit behind why its share price hasn't been recovering as well, but the dividends being paid by these energy companies continue to climb higher. I don't support the idea of trading out of one holding for another just because of a couple of months of underperformance. But as I've always said since the very beginning, any of these dividend growth ETFs that we've looked at today are good picks. If you prefer VIG or SDY over SCHD, then you'll still make money if you hold it long enough. Some of these alternatives to the Schwab fund do offer more diversification and other features that might make them more appealing. You ultimately won't lose with any of these funds, whether you trade in SCHD for another or not. But with that being said, that's going to wrap up today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.